Today is October 16th, 2023, and this is your Monday market update. Briefly, if you've been watching these videos, especially last Friday, you know that I'm still in Israel and the war goes on. I'm safe and making plans on returning to Chicago soon. Please contact me directly if you have questions about that. I don't want to ignore it, but I also recognize that you're tuning in for market news. There are plenty of other outlets for all the rest. The tragic human cost and the declaration of war are parts that are especially horrifying for me. It is always uncomfortable to talk about market or economic impacts at times like this, but that is part of my job. So, as I said, please reach out if you want to talk more about it. Let's review the market action last week. There was a lot, and then we'll preview this coming week. So, Monday had the world and the US stock market wake up to war again in the Middle East. Stocks gapped lower at the open. You know what happened. So, let's talk about the outcomes. Oil prices were up, as we so often see when there's any kind of news from the Middle East. We also had Fed head Logan come out and say that if eco news stays strong, even with the rates as high as they are, the Fed may need to do more. Was he hinting about more hikes? Is that what the narrative of the market is? Is it priced in? I'm not so sure. The bond market was closed for Columbus Day, so the main driver of the markets recently, the 10-year yield, had no real action. Markets did see the signal through the noise, though, even as noisy as it was, and it did stabilize late in the morning. Even though the bond market was closed, we are in 2023, for goodness sakes, we can get after market trading on pretty much anything. So 10-year Treasury futures, still trading thinly even without bond trading, they brought the expectation of yields back down. As we know, that was good for stocks. The Dow, S&P, and Nasdaq all closed about half of 1%. We did see energy get a boost. Think oil and the conflict. Defense names also got a boost. Same thing, conflict. Newswires on the eco side and the market side were quiet. Most of the focus was on Israel and the Middle East. Market action indicated that they did think it will stay contained to Israel. Let's see. Tuesday saw markets really start to further ignore the market and move on, at least in this case. Stocks gapped higher at the open and gained some steam throughout the morning. Bond yields followed the futures from Monday and did fall to new October lows. This turned the yield headwind into a tailwind. China eco news was also good as the report of a new round of stimulus, upwards of a trillion yuan. U.S. eco news was ignored. Then there was a 1 p.m. 3-year Treasury auction that came in with a higher than expected yield, lower demand. This saw yields move up and stocks gave some back. The Dow finished up less than half of 1%. S&P and Nasdaq both up just over 0.5%. Markets had their eye pinned to the upcoming PPI and CPI numbers. We'll get into that in a moment. And the earnings from banks at the end of the week also coming in a moment. Wednesday was PPI day, and you know what? No one really cared. The market came in hot, and that would have blown the doors off the market another time. This day, not so much. The 10-year was in focus. Rates rising took the air out of the room as higher inflation data and war in the Middle East were ignored. Markets did open slightly higher, but that did not last. Bostic leaned in with the Fed comments on the hawkish side, and stocks hit new session lows in the early afternoon. We did get FOMC minutes, but like I told you before, not much to see here. There was a rally into the close, and the markets ended just off the best levels of the day. The Dow was up under 0.25%. S&P up about half of 1%. The Nasdaq up about 0.75%. Stocks were a little changed on Thursday while markets digested CPI numbers. Again, in the bizarro world we're in, the numbers were hot, and that should have given everyone pause. But core came in as expected. Jobless numbers still showing strength. Fed expectations moving up from a December hike, and still the market was focused on the Treasury yield. It was stable, so there was an attempted rally into lunch. But again, the 1 p.m. Treasury auction, this time 30-year, and with higher rates, lower demand. Remember the issue we spoke about, a lot of new bond supply. Not sure why anyone is surprised that demand is not keeping up. The dollar was up. By the end of the day, markets stabilized with oil lower and yields coming back down a bit off the lows, but still lower on the day. All three indices down about 0.5%. Note that 2 times this week we have similar closing percentages. As I've told you before, this smells a lot like the algos, and I'm not sure that with all of the non-market news, the war in the Middle East, that the algos are not really in charge. Friday saw everyone to the other side of the boat again, this time earnings. On the open, all three indices up about half of 1%. JP Morgan beat and was pretty much unchanged at the open. Citi up about 2% on the open. Wells Fargo too. Add in some BlackRock, slightly lower on mixed earnings also. Financials will be a key to the market, and they always kick off earnings season. So be ready for the next 4 or 5 weeks. We'll hear a lot about earnings. Regional banks up next week. Oil had a big jump on top of the war. U.S. sanctions on Russia were made stronger. Crowd favorite Netflix got a downgrade and ran into some selling. Add in a bit of Fed speak. Harker got in and said that rates don't need to go higher. University of Michigan sentiment survey had sentiment drop and inflation expectations jump for the day. The Dow added about 0.25%, S&P down by about half of 1%, and the Nasdaq was down by 1.25%, the tale of three separate markets. For the week, two of the three were up. Dow up 0.75%, S&P up 0.5%, and the NASDAQ was down just under 0.25%. What to expect this week? There will be focus on two main news items, and then, of course, you'll have to watch the rates to see to which tune the markets are playing. Main news will come from earning, lots of them, a few today, mostly the rest of the week. You also get retail sales numbers, and this is a big number, but we will have to see if anyone pays any attention. Remember, as LPL Chief Global Strategist Quincy Crosby likes to remind us, we are 68% consumer driven in the U.S. economy. What happens with the retail is important. Service is huge too, but this week we'll get the retail number. Housing information, Beige Book, leading economic indicators, and more. Earnings. Earnings will be the thing to watch, the signal and the noise, if you can hear it. Q2 earnings were down almost 3%. Q3 is estimated to be up about 1.5%. I will note that the issue with this is that some sectors skew the overall numbers. So remember that I do think that valuation is the long-term focus that we should watch, and that is what I do. That is what I do for you. For the Fed head parade, Harker, Bowman, Kashkari, Barkin, Waller, Williams, Cook, Powell, Goolsby, Barr, Bostic, Logan, and even Mester. That's 13 in case you're keeping score. So for now, that is what was and what will be. My heart is heavy here in Israel. I will end with only this. I hope you can all join me in praying for success and peace soon. Have a good week. I'll be back on Friday, maybe even from the United States, unknown as of now. Have a good week.